Buydowns can be another confusing and unfamiliar topic in the mortgage process. So I want to explain the two main categories of buydowns, which are permanent rate buydowns and temporary buydowns, and focus on three primary aspects within each. Number one, an explanation of what these are. Number two, how these will impact your mortgage. And finally, number three, examples of who these will be beneficial for. So let's take a look. Well, the more common of the two is the permanent interest rate buydown. And what is that? Well, this is where you may have heard of terms like discount or points or discount points. This is that really attractive interest rate that you see on TV or online. And the discount is what you would notice in the fine print in the disclaimer, how much that costs to get that attractive interest rate. So the permanent rate buydown is the cost, the price, the discount or points for the rate that's lower than you would otherwise get. So it's an added closing cost that you pay at closing to permanently reduce the interest rate for the entire time that you're in this mortgage. So how does a permanent rate buydown affect your mortgage? Well, you're gonna have more closing costs and you're gonna have a lower interest rate. So it helps me to think of interest rates and closing costs on either side of a seesaw, okay? When one goes up, the other goes down, and vice versa. So the trade-off is you get a lower interest rate, so your payment is lower and maybe achieve your payment goal. On the other hand, you have an extra line item of closing costs, and that's how it affects your loan. Finally, who will this benefit? Why would somebody come to closing with thousands of extra dollars to get a lower interest rate? Well, mathematically speaking, there is a break-even point. So you can look at the interest rate with no discount points versus an interest rate with discount points and calculate a break-even point. And that's what we do for clients and say, okay, if you know for sure that you're gonna be in this home or this loan longer than X amount of months or X amount of years, then maybe consider buying discount points to permanently lower your interest rate, because over time, paying that lower payment and that lower interest rate will benefit you. The other side of that is if you did pay discount points at closing and it was going to be a benefit after 5 years of living there, but you decide to move or refinance or do something with that mortgage before the 5-year mark, there's no refund for that discount point, that permanent rate buydown that you paid at closing. It was a closing cost and it's gone. So these are geared really only for the clients who know for sure they're going to be in this home and in this loan for a long period of time. An average break-even point would be about 5 to 7 years. So really you want to know that you're going to be in this home and in this loan for 10 plus years to really reap a significant benefit out of a permanent rate buydown. Well, temporary rate buydown is what it sounds like. The rate's going to be lower temporarily. Temporary rate buydown is essentially prepaid interest. You're paying extra at closing for future interest rate payments for a period of time. So how do temporary rate buydowns work? They're typically offered in either 1-0, 2-1, or 3-2-1 options. And those numbers correlate to the years of your mortgage, the first years of your mortgage. Let me explain what I mean. So 1-0 buydown would mean that the first year, your monthly payment will be based off an interest rate 1% less than you locked in for closing. So say you locked in a 5% interest rate. Well, if you had a 1-0 buydown on that 5% 30-year fixed rate mortgage, your first year monthly payments will be based off of a 4% interest rate. If you had a 2-1 buydown, that same 5% 30-year mortgage, the first year monthly payment in a 2-1 buydown will be based off of a 3% interest rate. Then the second year mortgage payment, the monthly payment will be based off of a 4% interest rate. And then in years 3 through 30, that's when you would make that monthly payment based off of a 5% interest rate. Now 3-2-1 buydown will be the longest buydown that's around these days. If we locked in that 5% mortgage rate, probably guessed it, it's going to be 3% less than that 5% rate. The first year payment will be based off of a 2% rate. Then the second year will be based off of a 3% rate, third year 4% rate, and then years 4 through 30, that's when you would go to the 5% monthly payment. The temporary buydown will then be over and you would make the monthly payment based off of the rate that you locked in for your loan. So that's how the monthly payment side of things works. Now, how does the closing cost, how does closing work? How does that look different when you're closing on your mortgage? I mentioned before that this is prepaid interest, right? So ultimately, you're just prepaying this interest at closing. Say that 1-0 buydown example, say you were saving $100 a month by paying a 4% monthly payment versus a 5% monthly payment. Well, you're having 12 months of savings, right? And $100 times 12 is $1,200 for the first year. Well, at closing, there would need to be an extra $1,200 brought to closing to cover that first year savings. So it's prepaid interest. There's no real math going on to see when a break-even point would occur. It's just a temporary savings by paying less in interest for a period of time. And you would want either the seller or your lender to cover the cost of these funds to get a true benefit out of a temporary buy down. So who do we find that this is typically best for? Well, one is if the seller is offering a ton of incentives, a lot of seller paid closing costs, well, this is good use of some of those funds. But the other more common is someone who is early or advancing in their career, and for the house that they really like, they look at that monthly mortgage payment at 5% and think, man, it kind of makes me nervous right now, but I know in a few years it's going to be fine. Just right now it makes me a little bit uncomfortable. Well, this is a perfect bridge of that gap because the monthly payment can be comfortable now and next year and in years 3 through 30 when they know ultimately they can make that 5% mortgage payment easily. So if this is someone earlier advancing in through their career, this usually is a really good match with their goals. Having a general understanding of these complex mortgage terms is really beneficial when you're in the mortgage process. Taking the next step would be finding someone to walk you through numbers that are tailored for you individually. And if you're considering the mortgage process, that's what I would advise. Listen, knowledge is confidence, and confidence is key in the mortgage process, and that's what I want for you.